Good morning. I'm going to talk about financial statement of Safiya Bistro Sendirian Berhad SBSB. Statement of comprehensive income for the year ended 31 December 2024. Sales 1,200,000. Cost of goods sales 720,000. Gross profit 480,000. Operating expenses 270,000. Earning before interest and taxes 210,000. Interest 36,000. Earnings before tax 174,000. Tax 25% 43,500. Earning after tax 130,500. Statement of financial position for the year ended 31 December 2024. Now I am going to talk about the assets. Equipment 480,000. Less accumulated depreciation 96,000. Net fixed assets 384,000. Cash 420,000. Accounts receivable 240,000. Inventory 360,000. Total current assets 1,020,000. Total assets 1,404,000. Liabilities and equity. Accounts payable current liabilities 180,000. Bank loan long term liabilities 360,000. I'm going to talk about the financial ratio calculation based on the provided financial statements for Safiya Bistro Sendirian Berhad of 31 December 2024. Liquid ratios: A, current ratio, current asset over current liability equals to 1,020,000 over 180,000. The total is 5.67. Next, the B is quick ratio, CA minus inventory over CL equals to 1,020,000 minus 350,000 over 180,000 equals to 3.67. The second is efficiency ratio. A, collection period, account receivable times 360 over annual credit sales equals to 240,000 times 360 over 1,200,000 equals to 72 days. Now B, inventory turnover, COGS over inventory equals to 720,000 over 360,000. The total is 2.0. Now fixed asset turnover, sales over net fit asset, 120,000 over 384,000. The total is 3.125. Now the total asset turnover, sales over total asset equals to 120,000 over 140,400 equals to 0.85. The third one is leverage ratio. A, debt ratio, total liability over total asset, 540,000 over 140,400. The total is 0.346 times 38.46%. Now the last one is profitability ratios. A, net profit margin, earning after tax times with 100% over sales, so equals to 130,500 times 100% over 120,000, so the total is 10.88%. Now return on equity is earning after tax times with 100% over common equity equals to 130,500 times with 100% over 864,000. The total is 15.10%. Return on investment, earning before interest taxes times 100% over total asset, 21000 times with 100% over 1404000, the total is 14.96%.
Good morning. Today I will be comparing the SBSB value with the industry average. Firstly is the current ratio. Current ratio is 5.67 for the SBSB value, while the industry is 3.0. So it means it's been achieved. For quick ratio 3.67, while the industry is 1.8, also have been achieved. But for collection period, it took 72 days for SBSB value, while industry average only to 45 days. Inventory turnover, SBSB value is 2.0, while the industry average is 1.0. Fixed asset turnover 3.125, which is very close to the industry average, which is 3.2. Total asset turnover is 0.85, also very close with the industry average, which is 0.9. The debt ratio is 38.46, very close to the industry average, which is 40%, but still not yet achieved. Net profit margin is 10.88, the industry average is 18%. Return on equity is 15.10, while the industry average is 22%. Still need to do something to achieve the industry average, while the return on investment is 14.96%, while the industry average is 12%. That's all. Thank you.
Issue 1, low profitability, net profit margin and ROE below industry average. SBS profit from sales only is already 10.88%, while the industry average is 18%. So their returns on equity is 15.10% compared to 22% in the industry. This means they are not turning sales into good profits and not getting the most out of their honest money. In other terms, profit margins show how well the businesses controls costs and runs smoothly. The low margin years suggest expenses are too high, RM 270,000 in operating costs compared to sales, so it is lowering the profit. ROE, which breaks down into profit margin times assets use time debt level, shows that even with a good asset use and debt, the weak margins dragging down the overall returns for the owners. This could be caused from bad pricing or wasting money, and if it not fixed, the business might not last long. Issue 2, inefficient receivable management. Collection periods exceeds industry average. SBSB takes 72 days to collect money from customer, way longer than the industry, which is 45 days. This means cash is stuck in unpaid bills for too long. This is about managing the money the business needs to run day to day. Good receivable handling keeps cash flowing, rolling, and avoids company running out of money. A long wait increases the cost of holding onto that cash, like missing changes to invest the money, and raises the risk of never getting paid with sales at RM 1,200,000 and the receivable at RM 240,000. This problem hurts mess up the cash flow. Even though they have a strong short-term money ratio, it might force them to loan more or ask the shareholders for more funding.
Using appropriate financial management principle demonstrate how Safira Bistro Sendirian Berhad can address the financial issue identified in Part C. Based on the financial analysis, the two main issues are low profitability, net profit margin, return on equity below industry average, inefficient receivable management, collection period longer than industry average. Solution 1, improve profitability through cost control and pricing. Financial principle: following the principle of profit maximization and cost control, the company should manage expenses wisely and set the right price to increase profit. The action: reduce operating costs, cut unnecessary spending, negotiate with supplier and save energy to lower expenses. Review pricing and products, slightly increase prices on popular menu item and add premium choices with higher profit margins. Increase efficiency, improve kitchen and service processes to reduce waste and serve more customers quickly. Justification: lower cost and better pricing will help raise SBSPS net profit margin from 10.88% to 18% and improve return on equity ROE by earning more profit from the same investment. Solution 2. Strengthen credit and collection management. Financial principle: based on working capital management, good control of customer payments help maintain healthy cash flow and reduce bad debts. Actions: shorten credit terms, cut payment time from 72 days to around 45 days and give discounts for early payment. Tighten credit control, check customer background, send reminder and charge penalties for the late payments. Use digital tools, track payments using accounting software for faster collection and fewer delays. Justification: by collecting money faster, SBSP can improve cash flow, reduce the need for loans and has more funds available for daily operation. In conclusion, by applying cost control and efficient working capital management principle, Safira Bistro Sdn Bhd can improve both its profitability and cash flow position. These measures will help the company move closer to industry performance standards, increase shareholder value and strengthen long-term financial sustainability.